Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Bkv Corporation Annual Report. Bkv Corporation offers a diverse range of businesses and services that cater to the natural gas industry. At its core, the company is involved in the production and sale of natural gas from two major shale formations, the Barnett Shale in Texas and the Marcellus Shale in Pennsylvania. In addition to producing and selling natural gas, Bkv Corporation also provides various supporting services. These include gathering, processing, and transportation of natural gas, which are essential for ensuring a smooth supply chain. The company's expertise extends beyond these core activities, as it is also engaged in power generation. Furthermore, Bkv Corporation has made significant investments in carbon capture, utilization, and sequestration (CCUS) technologies. This innovative approach not only reduces the environmental impact of natural gas production, but also contributes to a more sustainable future for the industry. With its comprehensive range of services and cutting-edge technology, Bkv Corporation is well-positioned to meet the evolving needs of the natural gas market. The company's business operations are supported by its parent organization, Bkv North America Corporation, which provides strategic guidance and resources. Founded in 2015, and headquartered in Denver, Colorado, Bkv Corporation has established itself as a major player in the natural gas industry. Bkv Corporation's stock price has experienced a significant increase of over 68.72% in the past year, driven by several key news events and strategic developments. The company's strong financial performance is a major contributor to this growth, with impressive results for the fourth quarter and full year 2025. Bkv reported net income of $173.1 million, or $1.98 per diluted share, and achieved 47% EBITDA growth in 2025. Strategic acquisitions and expansions have also played a significant role in the company's success. The acquisition of a control position in the Bkv BP Power joint venture and the expansion of natural gas assets through the purchase of Bedrock Energy Partners' Barnett Shale assets are expected to accelerate growth in the power sector. In addition, Bkv has made substantial progress in its carbon capture, utilization, and sequestration (CCUS) business. The company's CCUS projects have successfully sequestered significant amounts of CO2, and it has reached a final investment decision on its East Texas project. This growth in the CCUS sector is expected to contribute significantly to the company's future success. The company's commitment to returning value to shareholders through a $100 million share repurchase program has also boosted investor confidence. Analysts have maintained or upgraded their ratings for Bkv, with a consensus of moderate buy and an average target price of $31.86. Overall, Bkv Corporation's strong financial performance, strategic acquisitions, advancements in CCUS, and shareholder initiatives have all contributed to its significant stock price increase over the past year. Bkv Corporation maintains a market capitalization of $3 billion, broadly in line with the industry peer group. Bkv Corporation trades at a higher price-to-earnings ratio of 16 times and a higher price-to-book ratio of 1.46 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 30% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. Although shareholder equity has increased, the share count has risen while revenue is declining. This raises concerns that equity growth may be driven by dilution rather than business performance. The sustainability of the business model remains unproven. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth for Bkv Corp can be attributed to several key factors. Firstly, increased commodity pricing has contributed significantly to the company's revenue growth. Additionally, drilling activity, acquisitions, extensions and discoveries, improved recoveries, and purchases of minerals in place have all played a crucial role in driving revenue upwards. The company's natural gas sales have also seen a notable increase, rising from $57.7 million in 2023 to $67.7 million in 2025 in Pennsylvania, and from $648.5 million in 2023 to $173.1 million in 2025 in Texas. Furthermore, the company's NGL sales, although experiencing a temporary decline in 2024, have rebounded strongly in 2025, reaching $518.8 million in Texas. In terms of specific revenue streams, marketing revenues and midstream revenues have also seen significant growth, increasing from $8.7 million to $12.3 million, and from $10.5 million to $13.4 million respectively in Texas between 2023 and 2025. Overall, these factors have contributed to the company's revenue growth, with a notable increase in sales across various product lines. Net income experienced significant fluctuations between 2023 and 2025. Initially, it decreased by $79 million due to an income tax expense, followed by a decrease of $1.9 million. However, in 2025, net income increased by $427,828, marking a 73% rise from the previous year. This increase was likely driven by optimization efforts within core businesses, including the use of technology and data analysis. Profit margins also underwent changes during this period. They rose by 0.1% from 2023 to 2024, but decreased by 0.3% in 2025. The company's exposure to interest rate risk and commodity price fluctuations contributed to these variations. Additionally, increasing costs of compliance with environmental laws and regulations had a negative impact on profit margins. The primary reasons for the changes in net income and profit margins were largely driven by external factors. These included increased regulatory burdens, high capital requirements for carbon capture and utilization projects, competition for limited investment capital, potential abandonment or delay of certain projects, and rising costs of equipment and capital. The company's ability to generate positive operating cash flow is a mixed bag. On one hand, several pages indicate that the company is indeed generating positive operating cash flow. For instance, on page 101, net income attributable to Bkv was $173.1 million, and net cash provided by operating activities was $242.7 million. Similarly, on page 113, it's mentioned that the company generated positive operating cash flow for the years ended December 31, 2025, $242,707,000, 2023, $123,076,000. Additionally, pages 120 and 124 also support this claim. However, there are also instances where the company is not generating sufficient cash flows to satisfy debt obligations, page 67, or where operating cash flow is subject to various variables, page 72. Furthermore, page 159 shows a negative operating cash flow of $1,234 million. These inconsistencies make it challenging to determine the company's overall operating cash flow. Nevertheless, based on the majority of the evidence, it appears that the company is generating positive operating cash flow in some years and under certain conditions. The company's debt level has undergone significant changes over the past year. Initially, total debt increased from $165 million in 2024 to $486.8 million in 2025, indicating a substantial rise of $321.8 million. However, this trend is contradicted by another report that shows a decrease in total debt from $239.9 million to $216.6 million. Regarding interest expenses, there are conflicting reports. According to one source, interest expenses increased from $0.8 million in 2024 to $2.5 million in 2025, indicating a significant rise of $1.7 million. On the other hand, another report suggests that interest expense decreased from -$72.9 million in 2024 to -$63.3 million in 2025. It is worth noting that there are discrepancies between these reports, making it challenging to determine the actual change in interest expenses. Nonetheless, one thing is clear. The company's debt level has increased significantly over the past year, while the trend for interest expenses remains unclear due to conflicting information. The company's outlook and strategy are centered around expanding and optimizing its existing natural gas production operations. This is evident in the Pad of the Future program, which will continue to drive project activity and enhance efficiency. Management also notes that commodity prices will remain volatile, necessitating hedging strategies to manage risk. To achieve long-term value creation, the company is investing in growth initiatives, including contract labor, employee-based compensation, and information technology-related expenses. Additionally, management is focused on making strategic acquisitions that align with its business strategy, such as the Bedrock acquisition. The company's strong financial position, having paid down debt and terminated unfavorable credit agreements, provides a solid foundation for these initiatives. Furthermore, environmental sustainability is a key area of focus, with management noting that environmental expenditures and liabilities are a priority. Overall, the company's strategy appears to be centered around driving growth, managing risk, and prioritizing environmental responsibility. The company has made several strategic acquisitions to expand its operations and increase revenue. Notably, the Exxon Barnett acquisition and the Devon Barnett acquisition have been significant investments in the Barnett Shale region. Additionally, the Temple I and Temple II power plants were acquired through the Bkv Power joint venture transaction. The Bedrock acquisition has also been a major investment, with multiple mentions throughout the summaries. Furthermore, the company has invested in various projects such as the Eagle Ford project, Cotton Cove project, and East Texas project to diversify its operations and increase production. These acquisitions demonstrate the company's commitment to growth and expansion. On the other hand, the company has also made strategic divestitures to optimize its portfolio and focus on core assets. The sale of Chaffee and certain non-operated upstream assets held by Chelsea is a notable example of this strategy. By shedding non-core assets, the company can concentrate on more profitable and high-growth areas, ultimately driving long-term success. The company's dividend payment history reveals a mixed picture. Despite paying dividends on multiple occasions, these payments were restricted due to debt agreements. This indicates that while the company has technically paid dividends, its ability to do so was limited by external factors. Regarding share buybacks, the situation is more ambiguous. A 2-year program was authorized in 2025 with a budget of up to $100 million, suggesting an intention to repurchase shares. However, another summary contradicts this, stating that no shares have been bought back. As a result, it remains unclear whether the company has actually carried out share buybacks or not. Supply chain disruptions pose significant risks. The extracted summaries reveal numerous concerns regarding supply chain disruption that could impact the financial condition and operations of companies. Potential risks include physical disruptions caused by climate change, termination or sustained disruption in natural gas production, shortages of equipment and personnel, inability to obtain key equipment, land use disruptions due to lack of ownership, global supply chain disruptions, pipeline infrastructure constraints, and industry-wide supply chain disruptions. These concerns are widespread, appearing on multiple pages throughout the summaries. The potential for supply chain disruptions is significant, with various factors contributing to these risks. Companies must be prepared to mitigate these risks to ensure continuity in their operations. That concludes the financial summary for Bkv Corporation. Feel free to comment below, and I will be happy to answer them when possible.